Good morning from London. This is Bloomberg Markets Today. I'm Kriti Gupta alongside Tom Mackenzie and Lizzy. The cash trade just less than an hour away. Here's what you need to know. Central banks speak dominating the trading days. We get policy views from the Federal Reserve to the ECB, plus investors preparing for the switch to the T+1 settlement period. That, of course, kicks off today. In the countdown to the UK election, dozens of business leaders back the Labour Party's economic plans ahead of a speech from Shadow Chancellor Rachel Reeves. We'll speak to the UK Shadow Business Secretary Jonathan Reynolds joining the show. And tensions grow after the killing of an Egyptian soldier in a clash with Israeli troops at a Gaza border crossing. We're going to bring you the latest from the Middle East.
OK, let's check in on these markets. As Kriti was saying, a major week, of course, in terms of the inflation story with details out of the US on Friday, but also inflation data out of the Eurozone, Australia and Japan. Currently, European stock futures pointing to modest gains of about 0.1%. The FTSE 100 looking to add 5 points, up just shy of 0.1%, coming back after a three-day holiday here in the UK. The US 10-year at 4.46, euro dollar at 1.08. Bit of softness in the dollar in the session today, giving a lift to the euro. And, of course, we continue to pass comments from European central bank officials as well. 108 on the single currency, up just shy of 0.2%. Markets today starts right now.
All right, good morning. It is Tuesday. It is May 28th. I had to check the date there. But look, there's a lot going on. Tom was just talking about it. There's inflation data later in the week. There's plenty of economic data as well. We've got that T+1 settlement, so a little bit of market plumbing as well. Plus, of course, we are on politics watch. As always, in the UK, in the EU, there's always that U.S. trade agenda in the background. There's a lot to digest, but I think let's start with some of the Fed speak here that we're getting. Over in the Japan right now, you have Michelle Bowman, Loretta Mester making some pretty strong comments, talking about reducing the Fed balance sheet, talking about some of the bigger, more macro concerns that aren't as tradable as, say, a rate path discussion, for example.
Well, first of all, you just brush over the plumbing of the markets. And I know you're really doing a deep dive on that, and we'll get your take on that, Kriti, because I know that's really in your ballpark in terms of the T+1 changes in the US. But yes, look, it's really consequential and it's really symbolic, isn't it, that this is happening in Japan, because we talk about the rate differential between the BOJ, the challenge that is for officials there as they think about the Fed at 5.25 to 5.5%. So yes, really interesting as well. Loretta Mester saying, hang on a second, the Fed should do a better job at communicating in terms of transparency around its statements. So that was interesting. Michelle Bowman saying that, yes, the runoff in the balance sheet, the QT, has to keep going, but maybe she would have been open to pushing it back in terms of slight reduction. So the QT question in focus for these officials, but also communication.
Yeah, it's funny that Loretta Mester is saying that actually short statements from central bankers can be problematic. I hear the opposite complaint here in the UK, that the statements are too long, too nuanced, and people can't tell whether we're coming or going when you hear from certain BOE officials.
Well, I love the fact that we're talking about the QT story in the context of the BOE as well in particular. And I thought this was interesting that, remember, Michelle Bowman, for our international audience, is the hawk right now on the committee. Kashgari, of course, not a voting member, but he's also, we're expected to hear from him later today as well. All of that getting folded into the T+1 conversation. Here's where I'm bringing the market plumbing in. I think this is fascinating. Mark Cudmore yesterday joined the program and said, this is a non-event, essentially. But there are two litmus tests this week. You've got, of course, the rebalancing, the MSCI rebalancing. I keep stumbling all over these words. On Friday. On Wednesday, though, you have that double settlement where you have both the Friday trades and the Monday trades catching up. And that's really where the industry is going to say, can we handle this? Is this okay? I thought our BN reporting was really interesting in that we had them comparing this to the 1920s, the roaring 20s, for example, saying that the meme stock craze that pushed this forward is actually really just a replication of what we saw back in the good old days.
Yeah, look, we can only hope that we get the roaring 20s again. Well, maybe not the inflation, but the growth, perhaps. We also had some interesting ECB speak yesterday. We were in, all of us, I think, for the bank holiday, but this is kind of what was driving European markets yesterday. So it was conflicting. You had the chief economist, Philip Lane, ruling out further cuts beyond June. And then you had François Villeroy de Gallo, coming in and saying, no, maybe we'll cut in July as well as June, and that boosted stocks in the afternoon.
Well, that was a clear pushback to Nagel, wasn't it? Because Nagel come out a few days before and said, look, just because we go in June doesn't mean that opens the door to continuing and repetitive cuts from the ECB. We're going to cut in June, we're going to pause, we're going to assess the data. Villeroy saying, hang on a second, we are meant to be data dependent, so why are you effectively ruling out, because that seemed to be the message from Nagel, of course, on the hawkish spectrum, why are you effectively ruling out a July cut? And so Villeroy kind of saying, yes, we do follow meeting by meeting, which is why we should not take July off the cards.
And on top of that, we got ECB Schnabel, coming out this morning as well. And she really reiterated, I mean, to be fair, this is the conversation they're having over in Tokyo right now around the balance sheet in particular. But she's making a very targeted comment around QE in particular, saying it's not supposed to be really used outside of crises. And of course, in the last 20 years, haven't we been doing just that? To your point about the balance sheet, producer Dan Curtis made the point that if you actually look at the irony of this happening in Tokyo, where the BOJ's balance sheet is about 126% of its GDP, and yet we're talking about kind of rolling off some of these assets from the balance sheet. The BOJ on a completely different page than the ECB.
130% essentially of GDP.
Yeah,
it's remarkable.
Isn't that wild?
It's incredible. It's obviously we're still in that lead up, of course, to July the 4th in terms of the UK politics. So switching focus from what's happening in terms of the central banks. But it's been another big weekend, of course, what we've been hearing from the Conservative Party, the Labour Party. Lizzy, where do you think things stand? What's the latest in terms of whether or not anyone's been able to move the dial?
Yeah, so Rishi Sunak firing the starting gun on the election in the rain last week, and today's a big day on the economy. We'll hear from Shadow Chancellor Rachel Reeves, the woman who the polls say would be in number 11 by July the 5th. She's going to say that Labour is the key to stability, which is the key to growth for the UK economy. Now, we'll speak to Johnny Reynolds, the man who would be the business secretary, and the big debate really is how they're going to balance workers' rights with their pitch to be the party of business, but they seem to be leaning to the latter at the moment. You've got dozens of business leaders in the Times of London today saying, we back Labour.
And on top of that, then you also have Rishi Sunak making a little bit of an appeal on the pension reform. Explain that to us for an international audience who isn't familiar. Why does that matter? Yeah, look, Tom and I were discussing this earlier. It speaks to the electoral play to fend off reform, this right-wing party that's been potentially going to steal votes from the Conservatives. They want to appeal to old people. That's why over the weekend they were re-proposing national service, again, harking back to former times, 100 years ago. And they're also going for the July election so that reform doesn't have time to gather momentum. And now this tax break for pensioners. OK, a very different topic, of course, but we've had a reminder of geopolitical tensions and some remarkable events, again, unfolding in the Middle East, and distressing, of course, on a number of fronts. In terms of what's happening on the Middle East situation, particularly around Egypt, the Rafah border, and, of course, that refugee camp. Tensions then ratcheting higher in that region after an Egyptian soldier was killed in a clash with Israeli forces at the Rafah border crossing. It follows Israel's deadly airstrike on a refugee camp, which Prime Minister Benjamin Netanyahu has described as, quote, a tragic mistake. For more, then, let's bring in Bloomberg's Horizons anchor, Jumana Basecci, in Dubai. Jumana, what has the international reaction been? Let's start with that refugee camp bombing. What has the international reaction been to that event?
Well, first, let me just start off by saying that there has been an extreme intensification of violence in Rafah over the course of the weekend. That Israeli airstrike that you speak of is thought to have killed 45 people. And of course, there are many images circulated, graphic images of people being engulfed in flames. The initial response from Israel was to say that the attack was based on, quote, precise intelligence, and the aim was to eliminate 2 senior Hamas officials. But of course, there was international outcry as soon as those images started to work and as soon as it became apparent how many civilians had been killed throughout that attack. First out of the gates were some of the Arab states. Quite notably, Qatar spoke out, saying the bombing will complicate ongoing mediation efforts and hinder reaching an agreement for an immediate and permanent ceasefire. We also heard condemnation from the likes of Saudi Arabia, also key player in the region when you think about the potential for Israeli-Saudi normalization. Even the UAE put a response forward yesterday. That is interesting because they also signed a normalization agreement with Israel back with the Abraham Accords. But it wasn't just Arab states who were quick to comment. We also had very strong words articulated by some of the European leaders. President Macron tweeting that he was outraged by the Israeli strikes and that these operations must stop. There are no safe areas in Rafah for Palestinian civilians. That was followed up by commentary from EU's Joseph Borrell, who was also saying that they were horrified. I would say that the US approach has been slightly more nuanced. They said that they were disappointed and that the scenes were very disheartening, but has stopped short of going for a more critical reaction to Israel and what happened over the course of the last couple of days. But of course, the backdrop to this is the ICJ ruling, which came out on Friday, essentially telling Israel to stop with any military operations in Rafah. And of course, that didn't transpire over the weekend.
So that's the international community response. Where does it leave truce talks going forward?
I think that's a key question here, Lizzy. And what I didn't mention earlier on is, of course, we saw border clashes with Egypt. And this is an interesting information as well, because Egypt, too, signed their own peace treaty back with Israel in 1979. These types of hostilities are very rare. And indeed, one Egyptian border guard was killed at the border with Rafah yesterday. And so this also complicates some of these truce deal efforts, because remember, the key mediators from the region are Qatar and Egypt. They're attempting to bring Israel and Hamas together to get to some form of a truce deal. Earlier on, a few weeks ago, the Qataris had indicated that the fact that Israel were beginning to encroach on Rafah is a bit of a deal breaker when it comes to those discussions. And the big picture here is that Hamas are asking for a full cessation of hostilities, a withdrawal of Israeli troops. Israel say that those terms are not something that they would agree to. So there's still a lot of daylight between the two sides.
And at the same time, I believe Axios reporting whether or not this actually crosses the red line that the White House put out. Of course, Biden making those comments over the summer. Bloomberg's Horizons anchor, Jumana Bersecci, we thank you so much for that crucial context. As we're monitoring the geopolitics around the world, we're also going to be keeping some of the other key events that we are watching today. Day 3, of course, of President Macron in Germany. We already had some comments about the kind of kumbaya, for lack of a better term, coming out of the two nations, talking about that capital markets union, talking about collaborations that you are going to see on the economics here, as, of course, the defense for Ukraine as well. We'll continue to monitor that to see if there's more. But there's plenty going on the data front as well. About 3 p.m. UK time, that U.S. consumer confidence data potentially moving the bond market as several traders come back to their desks after that Memorial Day weekend. 4:30 p.m. UK time, the 2-year Treasury auction. How much demand really is there for the front end of the curve? Just 90 minutes later, you'll get a 5-year Treasury auction as well. And then, of course, what I think is a big event, of course, that T+1 settlement. There's a little bit of market plumbing here that doesn't necessarily relate to a broader macro narrative. We'll see how that feeds into some of the other major market-moving events this week, including central bank speak from around the world. We're already getting plenty out of that summit in the BOJ. We're also going to be hearing from Catherine Mann over at the BOE, and, of course, our favorite hawk, Kashkari, coming out of the Federal Reserve as well. There is plenty to digest here when it comes to this bond market, when it comes to the elections as well. And I think what's so great about this week is it's kind of where the geopolitics, the elections, are actually met with the markets, whereas markets tend to shrug off these kind of things.
I think it's half as much Fed speak this week as it was last week. And in the UK context, you can kind of put the BOE speak on the side a little bit, because we're not expecting a June cut, given that that political situation is the forefront here, unlike, let's say, in the US.
And to what extent, I wonder, is the PCE, it's expected not to be changed month on month or year on year. So that's the crucial data, of course, for the Fed on Friday. And to what extent that's priced in by these markets? How much sensitivity is there to assets on that PCE indicator? Whether it aligns with what we've been hearing from Fed speak, or does it come in with a surprise hotter? And what would that do? How much vulnerability is there in these markets to what could be another higher print? I mean, the expectation is going to be in line, but clearly that's the risk for these markets.
But even just in line is still already considered quite hawkish and quite hot, right? The idea is that it needs to be coming down pretty substantially. The other two things we'll add to the agenda as well. I believe we're still keeping an eye on the Anglo BHP deal as well. Hopefully we'll get headlines out of there. I think there was some commentary coming out of JP Morgan saying that in addition to, I'm getting really nerdy here, bear with me, in addition to the South African election, the impact there on the rand, which is of course a major EM currency, you also have to keep an eye on the Anglo BHP deal and what that means for reserves there. There's a lot going on in South Africa this week, of course.
With copper higher in the session today, but of course that deal and what happens to the assets of Anglo in South Africa is a really crucial part of that deal. So it's right to bring that to our attention as well. And again, a big, as you say, a big day, a big week for South Africa with that vote tomorrow. And coming up, we're going to look ahead to that election, of course, in South Africa with independent candidate and activist Zaki Achmat, who joins us live from Cape Town. Don't miss that interview, 7:30 a.m. UK time. So just shy of 15 minutes before that interview. Plus, UK Prime Minister Rishi Sunak will promise pensioners a tax cut if his Conservatives win the general election on July the 4th. Don't miss our interview with Jonathan Reynolds, UK Shadow Business Secretary. That's at 8:30 a.m. London time. Of course, if you have any questions of your own for our guests, send them to us on IB plus BBTV Go. This is Bloomberg.
In Europe, we're going to get fiscal consolidation. So you have weak private demand, you don't have the same investment boom. You have fiscal consolidation. So private demand is going to be weaker in Europe, which means that it's fairly clear that the ECB has to decrease rates.
Olivier Blanchard, Senior Fellow at the Peterson Institute for International Economics and formerly of IMF fame, speaking to Bloomberg simply about the future of the ECB and what that actually looks like. Echoing that sentiment, however, ECB Governing Council member François Villeroy de Guelho, I'm messing up that pronoun really, really badly, but basically what you need to know, he told a German newspaper that a June rate cut was a, quote, done deal. He added that the ECB should not exclude a second rate cut in July. That seems to be the narrative here. What are we talking about in terms of if June is already solidified in this market's pricing, what is the strategy going forward and how much of a difference does it really make? Let's get one more view on that. Joining us this morning, Christian Nolting, Global CIO over at Deutsche Bank Private Bank, joining us this morning. Christian, a pleasure to have you on the program. Let me put that question to you. If we know that a cut is basically a done deal in June, how much of a difference does a consecutive cut make when it comes to July or pushing it out to September, perhaps? How much of a difference does that really make?
Yeah, I think, first of all, the ECB has been very clear to communicate that they really want to go for a June cut, which would be the cutting cycle start. But I agree, why would they really say, okay, this is in the future months, that's what we're going to do? So I think they should leave some freedom for them to decide. And I think they can watch data, right? Is inflation really coming down? Is there still second round effects in wages? So I think they don't need to commit to this. They are, as I said, very clear on June. And then I would expect that they cut twice again this year, probably in September or December, maybe on a quarterly basis. But I completely understand the sentiment to say we are not going to commit for July already. So let's a little bit wait and see the data.
But it's only a difference of, 4 or 5 weeks? What would really solidify the case for July, in your view?
Well, if you really see that, for example, economy is really doing worse in Europe, then maybe they could do a bit more, or inflation is coming down faster. But I think what they really want to achieve to get the first signal in that they want to cut, and that's maybe then different from the Fed, and that has been discussion throughout the year. And then I think they really want to see data. I think we are always saying, right, inflation is quite sticky. So as a central bank, I also would be, if I may say, a bit cautious to cut, let's say, months after months. I would say one cut to start the cutting cycle, which, by the way, I don't think is a long one this time. Then I would say let's be data dependent and not give the market the signal now every month something is happening. Because if they do July again, then I think the market is doing or pricing in much more, which is probably not the intent.
Christian, how dependent are these European equity markets on cuts coming through from the ECB?
Well, I think if you look at the equity market, right, so it has been like a bit Goldilocks scenario, right? The market has been pricing in at the beginning of the year a lot of cuts from the central banks. Now has reduced this, but still the market is saying, well, the central banks will cut. And it's still a quite benign environment. I think that's what the market has been pricing in. If you look at equity markets performance year to date, I've just said to some, maybe if that's the end of the year performance, it's again a very good year in 2024. So I think that's what we call this Goldilocks scenario, what we have been seeing so far. And now I think we need to see, as I said, right, the central banks follow through with cuts. And I would expect the ECB to cut. And the Fed is also our call to cut, not this month, but probably again in the third quarter and the fourth quarter. That's what we've been saying. So there's also a cutting cycle from our point of view, starting from the Fed, which I think is a positive thing for equity markets.
What potentially derails then that Goldilocks era as you characterize this moment?
Yeah, I would say there is still a lot of focus on inflation. And if it's about central bank cuts, right, they need to look at inflation, what could bring inflation higher. Of course, if there is oil prices moving higher because of escalation of tensions, if you see so far, we have been seeing oil slightly going higher, but not substantially coming down, even in the last weeks. And then I think it's really through what you see on the interest rates, on the yields. We have been seeing when yields were moving higher in the US, above 450, for example, for the 10 years, the market starts to get a bit jittery. And what we do a lot is to combine this and to look at real yields. If you look at the real yields, if they have been above 250, that has always been a scenario where equities also had some setback. For example, if you look in April this year, now this has come off, but I think yields and energy prices coming, inflation, I think that's where the market really starts to get a bit more volatile from my point of view.
What about the impact of politics, Christian? Is there anywhere you're looking in the market for an impact from the European elections?
Yeah, I mean, there's a lot of discussion starting now, European elections 6th to 9th of June, which is quite near ahead of us. I think there's been a lot of discussion, for example, is there any policy change? How is the parliament being put together? Is it more right-wing? What are the consequences? There's a lot of discussions here in Germany about combustion engines. Is there a change? Maybe I think that's something to watch in terms of specific sectors, I would say. From my point of view, it's a very important election. If you see the tendency we see in Europe, and from that perspective, we do watch this quite a lot, although I think it might not have an immediate impact then on the central bank side. But I think from the political landscape, it's a very important election we see ahead of us.
What about the UK? Would you be buying Britain on July the 5th if the polls are right and Keir Starmer's Labour Party is the next government? Would it matter to you the size of his majority if he wins?
Well, I think what you always want as let's say, running a country is to have a clear majority in place. If you look at the polls, that seems to be the case. But, you know, I've been learning in markets that you cannot always look at polls in elections. So let's see about the outcome. If you look at history, I think by neither Conservative or Labour, you see a dedicated pattern in markets. So markets, I think, are really looking at the policy being executed from that point of view. So I would say we need to see what's the impact of the elections. You talked about tax cuts before. Is that coming or not? And I think then you look at different sectors from my point of view. So far, the polls look for a clear majority. But again, let's see what happens in the next weeks and how the election outcome will be. I think the clearer a majority, I think the better, of course, if you want to get your policy through.
Christian, in our final minute or two here, talk to us a little bit about the FX story. Lizzy was talking about the weakness that you're seeing perhaps in the monetary policy front, add on the geopolitics to it as well. A lot of folks are saying euro dollar at 108, cable at 127 doesn't really make sense when we're talking about this backdrop. When was that going to snap? When is that going to perhaps revert to its mean or actually justify the fundamentals in your view?
So if you look at dollar, for example, right, you could argue, and I think that's a discussion, if the Fed comes in later than expected at the beginning of the year, that should advocate for a stronger dollar, right? Nevertheless, from my point of view, what you've been seeing is, if you look at surprise indicators, for example, in the US economy, you've been seeing the US economy is doing, on the surprise side, a bit more negative. And Europe, on the other hand, is doing a bit better. That's something we shouldn't forget. If you look at PMIs just recently, they're still in contractory mode, but I think they're increasing. And it's not only the service sector which is doing better. I think that has also driven the euro a bit higher. So from our point of view, I think that could continue. Our forecast for euro dollar would be 110, say in 1 year's time, which is not a massive change from here. And of course, we shouldn't forget if there's any geopolitical risk coming in, any risk of that normally advocates for a stronger dollar. And I think that will stay the case.
OK. Christian Knowlton, Global CIO at Deutsche Bank Private Bank. Thank you very much indeed on these markets, this Goldilocks era and how the rate cutting environment ties into that. On euro dollar, 108 currently up just shy of 0.2%. Coming up, South Africans are enjoying a rare streak of uninterrupted electricity. We're going to take a look at why this has drawn suspicion ahead of Wednesday's election. That is next. This is Bloomberg.
South Africans have been used to this. Dinner by candlelight, pulling up to traffic lights that go dark, all due to frequent electricity cuts that have disrupted lives, impacting economic growth and prompting criticism from mining companies to retailers. Just last year, the power utility company Eskom could only keep the lights on for the equivalent of 82 days. But with an election on the horizon, South Africans have been enjoying a rare streak of uninterrupted electricity supply. Opposition parties have used the power crisis as fodder in the run-up to the poll, and now voters have become suspicious as to what lies behind the sudden recovery. Nearly 2/3 of South Africans said they'd consider not voting for the ruling ANC because of power cuts. Perhaps it's no surprise then that the government is trumpeting this winning streak. But the improvements have come at an environmental cost. The state has quadrupled the amount it spends on diesel to run emergency power generators. Still, though, the government insists the improvements are due to an increase in green power, including solar, through a public-private partnership. What they haven't said, though, is for how long the lights will stay on after the election.
That was Bloomberg's Jennifer Sabasaja reporting on South Africa's power crisis. And Jen joins us now live from Cape Town. So, Jen, what other issues are going to be top of mind for voters when they head to the polls tomorrow?
Yeah, Lizzy, I mean, there are a number of issues that are top of mind for South Africans, and we need to just think about how many are actually registered. 28 million South Africans registered. There's 9 major provinces. There's 70 political parties. And when we just think about the issues, there's a long list. If we think, first of all, that package that we were just showing there, electricity has been top of mind for a number of people day to day, as we were saying in that package. But also when we think about what it's cost the economy, in 2023, it cost almost $1 trillion in lost activity in 2023. And so voters are sick of that. They're also frustrated with the fact that we haven't seen growth. Unemployment is at 33%. So there are a number of issues. But really the question is, which of these parties, which of these leaders are actually capable and ready to actually turn things around? And the interesting part about this also, Lizzy, I mentioned there's 70 political parties. There's 11 independent parties. And that's where I want to bring in the guest who is standing with me today. His name is Zaki Ahmed. He is a former member of the ANC ruling party, running as an independent, though, here in the Western Cape, which is a major province, obviously, in this election. Zaki, thank you so much for your time. So for the first time, we are seeing independent candidates allowed to contest in this parliament, in this vote. How do you what sort of dent do you think independents and undecided voters might make tomorrow?
I do not believe that independents will make an enormous dent in the ANC's in the vote nationally, because they've made it virtually impossible for independents to stand. What I think is that the vast majority of undecided voters are ANC voters, mostly people with an affinity, historical affinity, who know that the party that I used to belong to has become a monstrous body that has become basically a criminal franchise. And so I think people would be voting for stability rather than voting for the criminality. And that, for me, is very important.
So are you saying then stability means the ANC retaining the majority?
Not necessarily retaining the majority, but definitely being the largest party with a very slim need for a coalition, but also possibly just a slight majority. I think the place to start for me is the fact that 90% of people that I've interacted with, more than 90%, I would say close to 100%, are working class people in our black African townships, in the colored townships, who suffer enormously. Children who are autistic, sitting in floods, women suffering darkness differently, because when Eskom goes out, darkness affects women differently than it affects men. So, but what most people are is patient, disappointed, but as long as there would be some progress, people would understand that it's going to take time to fix all the problems of the country. But the problem is that the African National Congress has deepened inequality, undermined state capacity, and that has meant that our electricity, our passenger rail transport, our insurance industry, all in trouble.
Well, let's talk about progress, and especially the fact that you are an independent. If you were to be elected into Parliament, could you potentially take on the ANC and the DA? I mean, do you think that could be progress for this democracy?
Well, I think definitely what is most important, I've helped build a movement outside Parliament, and that is critical to pressure what goes on inside Parliament. For me, the ability to be a committee member, to be able to ask any question, to get access to any document, to make that public, to show which are the good public servants and who are those who are corrupt and so on, that should make a difference. And I'm willing to work with any political party who is pro-working class. And the difficulty for me in this election has been the inability to get any political party to understand that what we have to do is fix the state, because otherwise the economy cannot grow. And there's no understanding of the global economy. So people blame Cyril Ramaphosa for the petrol price. No, I mean, that's just not right.
What do you think gets the economy going right away if you were to be elected into Parliament?
I think if there was a clear understanding that we need to put every energy into local municipalities, water supply, electricity supply, and focus all attention on this. Focus on Transnet, which is the freight rail. If we can focus just on a few things, and all the parties who want to see the country go forward work together, then indeed there's a possibility of serious economic growth, like we're having a return of economic growth to the Western Cape, and particularly Cape Town.
Well, and we've been seeing that. We were just talking about how we have seen load shedding, power outages decline in the past few weeks. There are some positive signs. Are we headed in the right direction?
I believe that we are headed in the right direction, but what is happening is the reason the grid is stabilizing is twofold. Some turbines or some stations are being brought back on, but the other side of it is that the private sector is opting out of the system.
Yeah. Well, and so then do they start buying into the system, potentially, or deploying their capital after May 29th, and where does it go?
Right. So I just want to refer to electricity again. So the big mining companies and so on have moved out and created solar panels and so on. They'll be selling that power back into the state. I think at this point we cannot. I'm a social democrat. I don't believe that basic services should be in private hands. But at this point, we have to rely on everyone who can put capital in, and that includes the private sector.
And Zaki, as a former ANC member, you mentioned that a lot of the undecided voters are ANC, potentially former ANC sentimental voters. Is the promise that the ANC promised in 1994, do you think it is a different party altogether right now, or does it make sense, the sentimental vote that's still there?
The African National Congress did excellent work in the first 5 to 7 years. From Becky's time, the destruction of life through HIV denialism, the arms deal and corruption started taking over the party, and you saw a different party emerging. And so I believe that the ANC deserves losing, but I don't want it to lose by too large a margin.
So then who makes the decision? Who do you think will be the deciding factor? Will it be the undecided voter, the young voter, women who, are registered more than men?
Women, older women who supported the ANC, who now in two minds about supporting it because they're waiting queues and so on, they will make the difference. Young people will vote for opposition parties largely, except those affiliated to the ANC, but that's a small number. They would vote for the opposition parties. I think women, black African working class women, is where the ANC's vote is. And that's also where my vote is.
Well, and what provinces then?
So I think if you look at there's several provinces that the ANC is in danger of losing. The most important one for them to lose is Gauteng, which is the heart of the economy.
Right.
They may not lose by such a large margin. They may even scrape in because they've really put their machine into it. The second province that they will lose or should lose is KwaZulu-Natal, because they're responsible for Jacob Zuma. And Jacob Zuma has destroyed that province.
Well, and he's doing
it again.
Yeah.
He's doing it again.
Right.
So that province they're likely to lose. But it's a very dangerous province, even if there's a majority of the ANC. There's three groups of armed men. Inkatha Freedom Party,
right,
MK Party and the ANC, and that's difficult. If KwaZulu-Natal is lost to the ANC loses nationally, because that's where it gets most of its votes from.
Yeah, and that's what we've been hearing. A lot of that is going to be the deciding factor, as well as Western Cape and Gauteng, as you were mentioning. Zaki, Ahmed, thank you so much for your time and for your insights.
Pleasure.
Tom?
OK, Bloomberg's Jennifer Dabasaja on the ground for us in Cape Town. Thank you very much indeed. We're going to be speaking, by the way, to the South African Finance Minister, Enoch Godongwana, a little later as well. So catch that interview on The Pulse, 9:10 a.m. UK time.
Meanwhile, coming up on the program, we are going to cover your stocks to watch, including ABN AMRO, the Dutch lender, increasing its wealth management reach by buying one of Germany's oldest private banks. We're going to get more details next. This is Bloomberg. Welcome back to Markets Today. We're about, we'll call it 16 minutes away from the cash equities open. Futures are pointing higher, a little bit of a catch-up trade perhaps as a lot of UK traders come back from that long weekend. What does that mean for the markets, though? Let's bring in our Markets Live executive editor, Mark Cudmore, for a little bit of what's on his agenda as we watch it. He's going to join us in just a few minutes, but I think what's really crucial when we talk specifically about these markets is there's an equity story here. There's that settlement story that I'm obsessed with. But then it's really all about the T+1, but there's all about the bond market later on in the week, right? You got core PCE on Friday. You have the Treasury buybacks. You have plenty of auctions. There's a lot going on.
And there was a sell-off in Treasuries last week. There was a sell-off in gilts as well. Yields up, on the 2-year at about 18 basis points by the end of the week. So a pretty pronounced sell-off in the UK on the back of slightly higher than expected inflation data. So to what extent the data this week builds on that? Do we get a further sell-off in these bond markets? Or do we start to moderate in terms of the pricing around central banks?
Yeah, it's not just the PCE we're getting. It's inflation data from Australia to Japan. So all around the world this week.
Plenty to digest. Let's now bring in our Markets Live executive editor, Mark Cudmore, see what's on his radar here. Mark, weigh in for us on what's going to be driving these bond markets. There's plenty of data. There's plenty going on. But I feel like we say that every week. And then net, Monday to Friday, on Friday, we end up right back where we were on Monday. What moves the markets this week?
Yeah, it's a very relevant question today, particularly, Kriti, because of the fact we've got these massive auctions. We've got a whole slate of supply due. But I don't think they're the big drivers in the market at the moment. I think we have PCE later on in the week. And then, of course, next week we have non-farm payrolls. And then we have the Fed meeting coming up and the new dot plot, the new projections. So those things, those bigger issues are really going to overshadow the short-term dynamics. I think that the backdrop picture here is that yields continue to see upward pressure. And that's the dynamic. That's kind of the general theme of this year. You're saying week on week we're not seeing much of a change. But if you look where we were 5-6 months ago, from the December Fed, we've had a massive change. We were pricing in more than 6 cuts from this year. Now we're still expecting cuts this year, but just about. And as I've kind of talked a lot about in this show, I think that ultimately the dynamic will be to question whether there will be even any cuts this year, or even the risk that we might have to consider the idea of hikes. I'm not saying a hike will definitely come, but that kind of narrative discussing that will come on the radar at some point.
And to some extent, it already has. You're seeing that kind of enter the broader macro narrative as well. Mark, we ask you over and over again, what is the ceiling on yields? Let me ask you the opposite question. What is the floor on yields right now? Yeah,
actually, great question. I think that 2-year yields, if there's a crisis, 2-year yields will get slashed quickly, or like even advanced that we kind of see that pricing. So I think 2-year yields can go much lower again. Will we ever really see the zero lower bound again? Sure, I don't see any reason to rule it out, but I think the neutral level has risen, so I think that the natural level of rates will be higher the next couple of years. I don't think 10-year yields are going to get as low as people think. I don't see 10-year yields getting back below 3.5% for many years to come. I think fiscal concerns are too high. We've changed the whole dynamic there. So I think even if we go into a real kind of growth slowdown, growth crisis, I think we'll see the front end collapse, but the back end will come lower initially and then go higher. So we'll see an aggressive steepening. And I think that's the dynamic for next crisis.
OK, Mark Cudmore, stay with us, because the chart of the day, the chart that caught my eye at least, is copper. Back on copper after, of course, it broke through that 11,000 record pricing last week. And then it softened. We're at, what, 10,500 or thereabouts. But in the session today, a bit of a pop in terms of the copper pricing. That's a longer-term view, of course. And interestingly, the backwardation, so pricing at the front end of the contracts, the near-term contracts versus longer-dated futures contracts, that backwardation appears to have been washed out. This is more about fundamentals now, and softer dollar seems to be part of the mix, as does the demand picture, or at least the expected demand picture out of China, as policymakers push through further changes, further easing of restrictions in the crucial financial hub that is, of course, Shanghai, in terms of the property market there. So a couple of factors come into play for copper. And I wonder, that ties to the question I have, Mark, to you on that inflation risk, or at least the risk. And you put it out there, the risk that maybe the Fed even has to consider a hike at some point, or at least that shouldn't be written off completely. Mark, to what extent is a tick up and a resurgence in inflation on the back of what we're seeing around the commodity sector a concern, do you think, for these markets?
I think it's the stickiness of inflation. I think that the market is still clinging to a very optimistic disinflation narrative that is possible but it's looking increasingly unlikely. And the most obvious component that we've known for a long period of time is the stickiness in the services sector. But we're now seeing, because of what's happening in commodities, as you highlight there, Tom, because of what's happening in shipping, which Kriti highlighted, I think it was yesterday or last week, we're now seeing that the goods side is also back into a reinflationary dynamic. And therefore, I think it's weird that we're still so convinced that rate cuts can come and yet have an optimistic view on the economy. There's no reason for inflation to come much lower without a severe growth slowdown. So I think people who cling to a narrative that growth will hold up and yet we'll get rate cuts, I think that's just frankly just a bonkers view. I'm very happy if you want to believe that growth's going to be fine and we're not going to get rate cuts, or growth's going to slow down aggressively and then we're going to get rate cuts. Whichever way, it's hard to have conviction. But you can't have the best of both worlds. And I think that's just it's that mythical soft landing narrative, and the evidence from both history and empirically, both empirically and theory, is that when you lose control of inflation like this, you do not control it without a severe curbing of aggregate demand, i.e. a recession. So at some point, no landing will migrate into hard landing. When, I don't know.
I wonder, Mark, where you think it leaves the UK, because when I'm at the ECB meetings, Christine Lagarde's often asked the question about euro weakness feeding into euro area inflation, if there's a gap with the Fed, between the ECB and the Fed. When you look at the UK story, most of our trade is with the euro area, right? But then you have to factor in commodities being traded in dollars. So when you look at the pound and the impact on UK inflation, where does the balance lie?
Yeah, it's stuck between both worlds, isn't it? It's stuck between a hawkish Fed and a dovish ECB. I think that ultimately the bigger dynamic here is the ECB are going to cut much less than has been priced only a couple of months ago. We've already seen the market move that way. So the ECB will cut in June. Will they get away with more cuts this year? Maybe one more, but I'm not sure if they'll even do that. And I think Bank of England, as a result, will probably not do much either, because they'll be restrained by the Fed also holding back the ECB from being as dovish as they'd like.
All right, Bloomberg's Markets Live Executive Editor Mark Cudmore, thank you for that. And remember, you can get up-to-date analysis and insight from Mark and the team by going to the MLive blog. That's MLIV on your terminal. Funny to see Ven Ram on the MLive blog, I think trolling our earlier guest, Deutsche's Christian Nolting, on his enthusiasm for the euro. He is kind of saying that the euro isn't quite poised to break out of this year's range anytime soon. Doesn't mention Christian by name, but there you go, I joined the dots. Now, let's go to our stocks to watch. Joe Easton from our equities team is on standby. Joe, what are you watching?
Morning, Lizzy. So we're starting in the banking space, where we've got a bit of M&A today as the Dutch lender buys a wealth manager over in Germany. They're doing a deal for Germany's Hauck and Aufhäuser, and that is worth potentially 672 million euros. They're buying it from Fossen International, the big financier, and they say this will add 26 billion euros in assets under management to their business. Now, ABN AMRO has already said that it sees wealth management as a way to offset declining net interest income as interest rates come down. So this is kind of playing into that theme. In terms of their shares, it has been a bit of an underperformer, given some disappointment that they haven't recently raised their earnings guidance. That could potentially feed into some positivity this morning. There are plenty of analysts actually bearish on this stock. 6 analysts have sell ratings, so potentially we might see a bit of a relief, given this M&A is adding that AUM to their business, as I say. We've also got some potential M&A in the home builder space here in the UK. Persimmon is eyeing Carla Homes. This is a report from Sky News over the weekend. It could be worth as much as £1 billion, according to Sky. This is owned by Legal and General, and Sky says we might see a bid ahead of a deadline next week. Now, it could potentially be at a decent discount, around 17%, according to an analyst from Morgan Stanley today, seeing that as a potentially good price at £1 billion. Here's the moves on a 1 year for some of those stocks. We have seen a bit of a rebound, given the interest rates potentially starting to come down in terms of the expectations. And we've already seen a deal in this space. We've seen Barratt Developments buying Redrose. So it looks like some companies seeing some value and seeing some opportunities for M&A in the UK home builder space at the moment. Then we're going to look at a stock we don't go to much. It's called Bachem. It's over in Switzerland. Now, bear with me. This is a chemicals company that supplies into the pharmaceutical space. And there's a report that a pipe has burst at one of its factories. And the reason this stood out to me is because there's a great Citi quote on this saying, "We don't know if it's likely to cause delays to the factory, but we expect shares to react negatively given it's critical for driving growth from 2024 and beyond." So we are expecting to see weakness following this surprise news of that pipe bursting. The chemicals firms do tend to be pretty cyclical, as we can see from the screen here. Had a bit of a rebound from the lows over in January, but still down around 9% over the past year. Keep an eye on that one. As I say, not one we look at that much, but pretty interesting given that issue at that factory in Switzerland.
All right, Joe Easton there, bringing us the connection between engineering and the markets. We thank you so much for that. Who's going to be back later after the market open, talk about what is seeing the biggest volatility. It feels like today is kind of going to be still a little bit of a macro day. We've got those individual movers that Joe was talking about, but at the end of the day, perhaps a little bit of wait and see into the back half of the week.
And I think the beige book of tomorrow is going to be really interesting as well. The economic survey for the US to kind of build out the picture, with Bloomberg Economics saying that the US consumer is now starting to crack. That from Bloomberg Economics. The beige book, of course, coming out tomorrow. Coming up, it is, of course, the markets open this Tuesday. Markets pointing high by around 0.2%. Stay with us. This is Bloomberg.
Welcome back to Markets Today. We are just a few minutes away from the start of cash equity trading here in Europe. Now, look, we're coming back from, of course, the long weekend in the UK and the US as well. Asia, of course, has been trading this whole time. You saw the session as kind of a little bit on the back foot, but not a major move down. I'm curious, even though futures are indicated higher, what do European traders take their cue from? Do they hop back into the market after the long weekend, or do they take their cue from Asia today?
It's funny that the CAC and the DAX, I think, were the lightest of the year yesterday, even though they weren't off. So any excuse for a holiday in Europe, and really guided by the ECB speak, the conflicting messages from Philip Lane and François Villeroy de Gallo in the afternoon, just showing you upon the pronunciation there, Kriti.
Yeah, I need all the help I can get on the pronouns. We know that.
Not the Spain correspondent. I'll try a little France.
De Gallo was a bit of he was basically the only thing that markets latched onto yesterday, right? And so there was a bit of positivity. European stocks ended in the green on expectations that maybe July, you get June and then July. That, of course, the guidance coming through from Gallo, pushing back against the more hawkish commentary. Commodities is interesting, but you're right. Asia was positive. It's turned now negative, closing in negative territory across the benchmark there. So that's interesting. And the iron ore story has turned around as well. It's now down, iron ore prices. We'll see how that reflects across miners as well.
Well, we also have to see how that reflects across luxury. We're going to get a check on Guy's famous Sensational Six as well. But yesterday, when we had this check literally 24 hours ago, one of the key kind of read across that we saw, it was broadly higher, but then you saw the LVMH, the Ferrari, that China luxury read through, very, very apparent in that trade. So we'll have to see if some of the heavyweights at least guide the market higher today or guide the market a little bit lower today. I feel like it's always a hop back into the market dynamic after a long weekend. You tend to see that on both sides of the Atlantic. We'll see if that makes a difference. But again, it is still very much a macro week, so we'll see how that goes as well. We are now officially marking the open of the European markets. The FTSE 100, slight indication lower. We're going to wait for those trades to shake out just a little bit as we see what's moving the benchmark.
Yeah, currently the FTSE 100 is flat after, of course, the three-day holiday here in the UK. 8,320. And, of course, we'll keep an eye on the mining space on the back of that. Up 0.1% so far in the session. We're going to get print over in Germany. The DAX up 24 points so far in just the first few seconds. And across the sectors, real estate at the top of the list. Now it's autos, in fact, up 0.5%. Very early days, of course, as we continue to look at prints. Coming through over in Italy, the FTSE MIB up 0.3%. Over in Spain, gains of 20 points. And in France, the CAC 40, Emmanuel Macron, by the way, still in Germany. That three-day visit continues. The CAC 40 currently adding 10 points, up 0.1%, 8,143.
Yeah, it's interesting just keeping an eye on one of the stocks that Joe was mentioning, Persimmon. Despite that M&A news, or perhaps because of it, that Sky News reported over the weekend, Persimmon shares down 1.4% this morning. Real estate kind of in the middle of the basket, as you say, though, a higher 0.1% in the middle of the stock 600 sectors.
And we should mention the leadership as well that we're talking about. You mentioned on the downside. On the upside, though, you are seeing a lot of commodities movers. Despite on the macro front, you are seeing a little bit of a turnaround just in the last hour or so. You are seeing oil now flat, for example, on the day. You are seeing forecasting a turnaround in copper. Even gold now turning negative by about 0.3%. How does that translate into the equity picture? You've got Total Energy, higher BP, higher Shell, higher Glencore. And from an index contribution perspective, those are your biggest movers. So a little bit of a disconnect from the macro and the micro this morning.
We had some interesting policy coming out of China as well. Just a reminder that they continue, of course, in their efforts to support the real estate market, where prices fell their most in something like three decades. So Shanghai, the authorities in Shanghai making it easier to make a home purchase, so reducing the down payment that you have to put down and reducing mortgage rates as well, at least giving officials the ability to reduce mortgage rates. So that is a theme that continues. And every time these policies come through, there's a bit of movement in the commodities, iron ore and copper. And then you see some reflection in the mining stocks as well, listed here in the UK. But that is a story that we continue to monitor, of course, and continue to evolve.
Yeah, and you remind me, Tom, that when we do speak to the Shadow Business Secretary of Labour later on, we've got to ask him about how they'll approach China and how protectionistic we will be in comparison to the EU and the US. Big story to watch here.
And haven't we learned that ultimately those protectionist policies, although perhaps sometimes popular with the voter demographic on both sides of the Atlantic, aren't always economically feasible, as we say. Another point that you bring up on the China situation that we didn't really have a read-through yesterday is that you're starting to see a weaker fixing as well. And that coming into, by the way, I believe a summit between China, Japan and South Korea, which, of course, all three really, you'll know this better than I, but kind of fight when it comes to the weakening of the currency in demand for that export business into the States.
Well, absolutely. Japan and China, there's some crossover there. There's some competition, particularly in terms of the manufacturing basis and the exports to that crucial US market. So, yes, the currency story is really crucial there. China, with those competing tensions, they don't want to see that massive outflow if they soften the currency too much. But clearly, they're feeling the pressure from higher rates in the US.
And there's plenty to digest there. We're going to be watching the geopolitics, again, the data as well. Some of the other pieces of data that I have my eye on it as well has a little bit more to do with the bond market than the stock market here. And there's that kind of difference when it comes to the asset class. For example, on Wednesday, the Treasury kicks off buybacks. You've got refundings coming on into the rest of the week. You've got Treasury auctions, not to mention that core PCE data on Friday. There's plenty to digest. Let's bring in a true expert here. Joining us now, Tatiana Greil-Castro, the co-head of public markets and portfolio manager over at Muzinich and Company. We thank you so much, Tatiana, for joining us this morning. Let's dive right into this bond market here, because I really do believe this bond market has ripple effects into the equity market and arguably the FX market as well. How much volatility can we expect, at least in the public debt markets, when it comes to some of the data we're going to get this week?
Good morning, Kriti. So for the data, but also, let's say, over the next few months, what we are thinking is that that the market has anticipated sort of a slowdown in inflation, which we are seeing, and it may not come down as rapidly, sort of, to the 2% target that, the policymakers are hoping, but it's going in the right direction broadly. So that is already anticipated by the market in the longer end. But nonetheless, the market still thinks that, there should be a rally when we get those rate cuts. Well, we've already priced in about 2.5 rate cuts in Europe, 1.5 in the US and the UK, which probably sounds about right, given where the economy is going. So we are actually cautious generally on rates. Near term, we think they're fluctuating as sort of a range-bound trade. But when you look at it fundamentally, it doesn't make sense for the long end to trade where it is if we think that the short end is only coming down, slightly. And if we think that a lowering of interest rates may actually improve the economic outlook. So generally, we're still cautious rates.
It's interesting that you say that lowering the interest rates may improve the economic outlook. Now, sure, but when we start to see some of this kind of bid into, say, the front end of the curve, which we're not seeing at the moment, but if we do, at least going into election season in the States, I'm curious how much of that has an impact on the real economy, i.e., is the markets pricing perhaps a little bit more in control of the effects on real economy instead of waiting for the lag that may or may not come from the Federal Reserve?
So generally, I think the expectation is that more or less whoever wins, there will be continued stimulus to the U.S. economy and probably more inflationary stimulus and other policy measures like, continued import tariffs and those things, which are clearly would be inflationary, but also stimulus would likely be inflationary. So generally, I think what we, but also broadly the market is expecting is that after the election is out of the way, that there will be more policy measures, and they're not going to be austerity measures. There will be fiscal stimulus measures. And when we already see in how much the outstanding amount of debt has increased, particularly in the US, and then if we see further stimulus measures, a permanence of tax cuts definitely under Trump that is expected, then we would see, continued fewer tax receipts. And then we'll have to see if the economy can grow significantly enough to offset it. And clearly, the Inflation Reduction Act was also a stimulus that was mostly driven by tax incentives. So, yes, it has caused a big boost in growth, but the commensurate increase in tax receipts has been less than, if clearly the growth had come without this stimulus program.
Tatiana, when you think about the stimulus then that could be coming through the pipe, plus a view, of course, on the Fed cutting and the expectations around that this year, even if it's moderated from 6 to just fewer than 2, does that give you the appetite? Does it give you the propensity to want to push further along the risk spectrum when it comes to credit? Is high yield looking more attractive in that environment?
So when you just look at a fundamental basis, you would think, well, I mean, if the economy continues to go well, actually, that would be a good time to increase risk and continue to go into sort of the lower end of the levered finance space. What we see is that given the initial yield that you are getting, is actually the incremental value is now diminishing. So yes, you still get somewhat of an additional carry. But when you look at the high yield market and also the levered loan market, you divide it up into double Bs and single Bs, where the double B market is always the one that suffers less default rate risk and less restructuring risk. But then when you look at and that is about 150 over the triple Bs, so not really it's not even 150 over, but it sort of has 150 spread, which is not that significantly more than the triple B market, but something to deal with for sure. Sorry?
Oh, I think we have some connection issues. Tatiana, can you hear us?
Yes,
okay.
I'm all right.
Sometimes this happens. Live TV. Okay, you can hear us. Continue, please.
Okay. Yes, I can. Sorry, somebody's interrupting me from Bloomberg.
Okay, but you were essentially saying, Tatiana, you're not being rewarded at this point for taking on more risk.
So that's the thing, right? I mean, we are not really rewarded particularly well for it. And I think what I wanted to say is when we go into the single B market, and this is still, I'm going back a little bit, because this is still the legacy of the very low interest rate environment. And with this low interest rate environment, what we are seeing is that the coupons are very low and the cash prices of the bonds are still significantly below 100. And so there is now this new movement or a trend where market participants are looking where they say, well, actually, this may be suffering from refinancing risk because it has a significant amount of debt outstanding. When then they have to refinance at a higher coupon, they may be struggling a little bit. And why don't we take advantage of the low cash price to go and see that we don't have to repay at 100. We can actually extend maturity, but we are using this lower cash price as the new 100, so to speak. And so there are on the margin definitely restructuring cases where that is taking place. And so we need to be careful not to take too much risk, because that could cause all sorts of sort of lender layering where new money is coming in and that gets boosted and gets priority, and the existing lenders get actually pushed down in the capital structure. And that is something where an investor could lose significant amounts. And that's where we are more cautious on that, because it could offset the additional yield that you are getting. And so we are very cautious on the lower end of the high yield market and the loan market because of those restructuring mechanics.
Let me just finally ask you then, how long can the private credit boom last when you've got rates coming down? And how could there not be a spike in delinquencies at some stage if the boom just goes on and on and on?
So there's two things, right? I mean, one is, so what is the willingness and the ability for instance, equity injections or additional money, as I just very briefly indicated. So there are ways around it to extend that because, of course, you usually run out of liquidity. So if the debt burden is becoming too heavy because the debt level is so high and whatever interest they need to pay is eating into their free cash flow too much. So that is one that you can cure clearly with a higher equity contribution, or you can cure it, as I mentioned, where they say, well, I write off 20% of the debt because rather than refinancing at 100, I'm refinancing at 80. And so you effectively write some of the debt off. So there are ways around it that may not be reflected in the default rate, but clearly for whoever is the investor in that debt, then, they could have to take some sort of haircut. So I think there is more going on behind the scenes than what meets the eye.
Certainly something we're going to be keeping a very close eye on, and certainly is going to be a very big topic of a lot of the UK and EU and US election campaigns that we're seeing around the world. Tatiana Greil-Castro, co-head of public markets and portfolio manager of our Muzinesh & Co. We thank you so much. A quick check on some of the sensational six stocks, our big heavyweights that we love to look at. You are seeing them broadly lower this morning. Your exceptions are going to be Ferrari and ASML. ASML, of course, the big mover this morning, I should say, in terms of index contribution. I should point out Schneider Electric down almost 1%. It is one of the stocks that is going ex-dividend. Net, you are seeing, I would say, kind of a little bit of a meh trade outside of ASML and Schneider Electric. Perhaps a little bit more excitement on some of those individual stocks. Joe Easton has those for us this morning. Joe, walk us through it.
So one stock that does have some excitement, Kriti, is Calliditas Therapeutics. We don't look at this one too much, but it is a biotech stock, and it's up around 78% today. So they've got a takeover bid from Asahi. Now, this is not the beer company. It is a Japanese industrial firm that's making a bid at an almost 100% premium for that firm. It's a maker of rare drugs, a big gainer today. Persimmon coming down. We've got that news from Sky News over the weekend. They could potentially be looking at a deal for Carla Homes at around £1 billion. Taylor Wimpey also speculated as a potential bidder, but it does look like Persimmon is the favourite. Taylor coming down very slightly today. And ABN AMRO edging up 0.7% after news of them buying H&A Bank, the wealth manager over in Germany. So lots going on in the deal space today. But Calliditas Therapeutics, the big gainer, up 78% this morning. A couple of other earnings to bring you. IDS, the owner of Royal Mail, they published their results at the close of trading on Friday. They look slightly weak. Another loss for that company, but potentially already priced in. There is a takeover situation on that stock at the moment. And then in terms of financial earnings, we've got Intermediate Capital in the UK and EFG, both in the wealth management, and ICG in the private equity space. ICG gaining 1.3%. Not too much movement in the EFG over in Switzerland. One stock doing well is Adler Group. This is in real estate, had a recent debt restructuring, and then numbers looking to reassure that sector. Of course, been hammered recently, and we're seeing it coming up around 6% this morning. Then we're going to go over to Spain, because there is a report in Spanish media that the government is looking to potentially ease a windfall tax, potentially remove it from the energy sector. That was something announced by Pedro Sanchez less than 2 years ago, and it is actually boosting some of those stocks. Repsol gaining 1.3%, Iberdrola, Endesa, all of those stocks getting a bit of a boost this morning. Then in terms of your morning calls, it's a couple of our favourite sectors. Firstly, gin and tonic mixer maker Fevertree. Surprisingly, this one is cut to sell at Goldman Sachs, and take a look at the damage in that one. It's down 7%. Goldman recommending you sell. Surprisingly, they're saying weakness in UK cocktail bars, if you could believe that, looking at the weekend trade on the bank holiday. And then finally, we're looking in the luxury space, the Birkin bag maker Hermes. This one gets an upgrade. Bernstein, they go outperform. They say Hermes is more defensive. It's got that pricing point that will keep growing throughout the recession. They like that one, and that is gaining 0.5%. So it's Birkin bags and gin and tonics today on your morning call.
I can see you touting a Birkin bag, Joe. I can see that over the shoulder, one of the modest ones. Do you get a modest Birkin?
Obviously don't know about Birkins, because that's not how you hold a Birkin.
But I have an image of Joe with it. I know. Joe, thank you very much indeed from our stocks team. Plenty more coming up, including EU elections. We'll be talking to an MEP on The View, as there's a bit of a shift to the right. We'll see if that continues, of course, at that vote through Europe. and we'll get the view from an MEP. Stay with us. This is Bloomberg.
This is Markets Today. We are 19 minutes into the European trading session. Traders waking up after that long weekend in the UK and the US. You've got stocks in Germany higher 0.2%, but in France they are lower 0.2%. And we can take a deeper dive into the politics of Europe now. The EU parliamentary elections kicking off next week. Nearly 400 million voters eligible to choose 720 MEPs. Renew Europe is the third largest group in the European Parliament, but divisions threaten to split that centrist grouping. And joining us now is the Vice President of Renew Europe and MEP, Katalin Chair, who is in Budapest. Lovely green Budapest, it has to be said, this morning. Lovely to have you with us on the programme. Let me start by asking a question that will have been on the minds of Emmanuel Macron and Olaf Scholz this week when they met. Is this election going to be dominated by the far right?
Well, first of all, thanks for having me. And I certainly hope this election wouldn't be dominated by the far right, but by the pro-European democratic forces who have been in the majority in the European Parliament for the past 5 years and who delivered really groundbreaking results when it comes to the recovery fund, to the swift response when Russia's brutal invasion of Ukraine happened, or when we mobilized jointly to protect our population against COVID. So I hope that there will be a pushback against the rise of the far right, and we will continue to grow as a strong and democratic European community.
What should the policy pushback be to address that shift to the right? Whether it's the AfD in Germany, whether it's the leadership that you see now in Italy, in the Netherlands, and, of course, Marine Le Pen over in France, tapping into a wellstream still of discontent and polling very strongly, particularly when it comes to Marine Le Pen over in France. What is the appropriate response that you see that should be put in place at a European level?
Well, I certainly think that the far right is strong because they are selling snake oil in a certain way. They are promising swift results and miracle solutions to problems which are deep and complicated. But I think it's very important to say that solutions and delivery has never come from the extremes. Only the center, only a pro-European majority can deliver on strong issues like the green transition, on the protection of Europe when a war is in our neighborhood, or when it comes to strengthening our democracy, which is certainly also on a ballot in many of our member states, including Hungary. So I think we have to focus on our results and also on how we plan to continue this fight for making Europe more prosperous and more competitive, and how we can deliver more for our businesses and our people who are certainly asking for some extra help here.
Would you be willing, in service of that goal, to work with members of the ECR, though?
I think the Renew group has been very clear. The Liberal group is not open to coalitions with the ECR group or with the ID group. We are aiming to continue with the centrist majority, what we had in the parliament for the past 5 years, together with the EPP and the SND. And I certainly think that in the time of such a peril when many member states experience democratic backsliding, I hope that also the EPP is on board with keeping Europe on the centrist path, on the pro-European path that is based on the rule of law and our joint commitment to protect our people from the war and from the economic crisis that we have to step up against jointly.
Are the EU's climate goals at risk in this vote? And how much has the climate agenda changed in Europe since the 2019 elections?
I think this parliament has delivered major breakthroughs when it comes to the fight against climate change. We have the Green Deal, where we are world leaders, I have to say, as the EU. And this is a commitment we have to continue to deliver on for the future generations, but also for those who are struggling from the effects of climate change right now, from the droughts, from the floods that we have seen all around Europe. And I am very worried that this agenda can be in peril indeed if the far right strengthens, and also if the EPP continues its course with looking away from the joint commitments we made at the beginning of the mandate. For us, it is crystal clear that we have to protect the green agenda, and we have to continue with a coalition that keeps on delivering for the sake of the planet.
Katalin, you sit on the EU's Foreign Affairs Committee. You've been a member of the delegation in terms of relations with the US. What would a Trump presidency mean for the EU?
Well, a Trump presidency would certainly mean that we have to play a stronger role on our own in the world. But it's clear that it's also the case if Joe Biden gets reelected. We have been the little brother of the U.S. for far too long. We have to be more autonomous in the way how we can protect ourselves, in the way how we can protect our economy. I think the strategic sovereignty path that many European leaders have been championing is the right way. And strong Europe means a stronger transatlantic relation. So it comes to the benefit of both sides and both partners. But we cannot be reliant on what happens at the US elections. We have to be able to rely on ourselves as Europe.
Well, at the core of that kind of consensus view in Europe, let's look inward for a moment. Katalin, you talk a lot about the defense story, the foreign affairs story as well. Does it concern you at all that Hungary seems to be at odds with the rest of the EU right now when it comes to aid towards Ukraine?
Oh, it is extremely concerning. And I have to say, not only concerning, it is shameful when I see the Hungarian government constantly vetoing key actions in the European Council's table. His vetoes do not serve the interests of Europe. They do not serve the interests of the Hungarian people. They only serve the interests of Vladimir Putin. And I think it's very important to show that Hungary is more than Viktor Orban, that we have a very strong opposition who is standing in favor of Ukraine and who is not in favor of selling out our country for Russia and China. That's what we experience from the government.
OK, Katalin Chair, who is Vice President of the Renew Europe Group. We thank you for joining us as we look ahead to those European elections. Great to have you on the programme. And we're going to continue talking about politics next. Labour in the UK pledging to bring growth back if it wins the July election. We'll speak to the Shadow Secretary of State for Business and Trade, Labour's Jonathan Reynolds. That's coming up next. So stay with us. This is Bloomberg.
This is Markets Today. We're about 30 minutes into the European trade, and it still feels like a little bit of a macro story, seeing some individual movers, but it kind of feels like we are knee-deep in election chatter between the UK, the EU, South Africa as well. We've got the US in the background. That's kind of a 6 month down the road kind of problem. And it kind of feels like the markets are starting to wake up for us, starting to look at the nitty-gritty in policy, both in the EU and right here in the UK.
Yeah, of course, we haven't got the manifestos yet here in the UK, but I can expect the leaks will start coming out in the next few days. I don't know how market moving they'll be, given that we know that the polls suggest it's going to be a Labour majority in the UK. We were speaking to the Bank of England's former official Michael Saunders last week, who said that markets are extremely relaxed about a Labour government. Will they continue to be?
And our own MLive survey, right, suggested that investors are relatively relaxed about the prospects of a Labour government, if of course that's what comes to the fore on July the 5th. But it does raise the question more broadly, in a massive year for elections, whether it's South Africa, the UK, the US, indeed India, how you price in that political risk.
Indeed. Well, Labour in the UK really wants to fight this election on the economy. And at 10 a.m. today, London time, the Shadow Chancellor Rachel Reeves is expected to say if you can bring business back to Labour, you can bring growth back to Britain. Yes, UK growth pales in comparison to US growth, but the UK growth problem is also shared by Europe. So I would ask, isn't it fair to put all the blame on the government? We can discuss now with the man who polls suggest is going to be Britain's next business secretary, Jonathan Reynolds. Morning, Johnny. Good to have you on the programme. We've been speaking to various business leaders about what they want from you if you win. We spoke to S4 Capital's Martin Sorrell. He says the workers' rights reforms proposed by your deputy leader, Angela Rayner, are your Achilles heel, the thing that worries him big time. S4 Capital is, of course, a big UK business. Why is Martin wrong?
Good morning. Yes, look, it's a significant day, and it is the terrain that we want to fight the general election on. We think the performance of the British economy and what that's meant for living standards and public services and for the burden of taxation in the UK is one that can be improved upon, and that is at the heart of Labour's plans. And what Rachel will say today, it's great to have this endorsement by so many significant business figures. I would push back on what Martin has said about the plan to make work pay. What we see in the UK is obviously a set of data around growth and productivity and business investment that needs to be improved. But we've got to do that in a way which benefits every part of the UK and which will also make sure that people have the kind of secure jobs a strong economy is built around. And we built that programme with input from trade unions, from business figures. The fact it's a part of our programme and at the same time has such significant business endorsement for the overall Labour position, I think is noteworthy. And look, when it comes to things like banning practices like fire and rehire, the balance we've struck, so we acknowledge, of course, that businesses at times need to restructure, but we need to do things in a way which isn't, for instance, like what we saw with P&O ferries in the UK. Let's be clear, the majority of business leaders in the UK value their workforce, they want to invest in their workforce, they recognise talent is their major asset, and they want to do the right thing by them. So I think Labour's agenda, we call it pro-work and pro-business, is at the heart of what the UK needs going forward into the next government.
So you've got a difficult balance between workers' rights and what business wants. Another difficult decision you've got to make is on fiscal policy. The Institute for Fiscal Policy is saying you can't just cross your fingers and hope growth is going to spare you those tough choices. So specifically, Johnny, which departments are going to have their budgets cut?
Look, I understand because of the position the UK is in and the Conservative Party's spending plans, the 1% rise in real terms spending and what that means for non-protected departments, that people ask that question. But of course, at the heart of Labour's plans is a belief that the economy can grow more strongly. And I think we've got very strong reasons to say why that is the case. And the reason people are paying in the UK a historically high tax burden for quite poor public services is that lack of growth. And so if you look at the specifics of what Labour has put forward, look at our plans, for instance, on a better relationship with the European Union, specifics like a veterinary agreement, an SPS agreement, mutual recognition, professional qualifications, labour mobility. These are practical things that will improve the competitiveness and investability of the UK and make growth perform more strongly. Look at our flexibilities around the apprenticeship levy, giving businesses the chance to currently use what is an underspend that would go back to the Treasury to invest in their workforce. Look at our plans for stability and industrial strategy. These are practical, measurable things that will improve the performance of the UK economy. And it's that message of optimism, of a stronger economy going forward, that we think is central to the message we want to convey in the election and frankly, what we want people to support when it comes to their choices on the 4th of July.
Johnny, when you talk about that closer relationship with the EU, if not in the first term, if we get a second term Labour government, if indeed we get a first-term Labour government, if we get a second-term Labour government, would you rule out a customs union with the European Union, given that on some basis, from the number crunching of our own team at Bloomberg Economics, you could be adding 4% of GDP to the UK with a customs union agreement?
It's not part of our plans. And look, let's be clear, let's not be talking about any second terms here. There's a big hurdle for Labour to get to beat the Conservative Party based on where we were in 2019. But the reason we haven't put that forward and aren't looking at that, and I understand how difficult Brexit has been for many businesses, you can't minimise that, it is that we recognise one of the principal causes of how the UK is viewed, particularly around the world by international investors, is the political instability where we've seen, in a calendar year, 3 British prime ministers. It's embarrassing, but it has a real economic effect. And we feel if we were to relitigate, to relive some of those battles around the constitutional structures post-Brexit, whether it's single market, whether it's customs union, we simply could not provide the political stability which people need more than anything else when it comes to doing business in the UK. So what we put forward instead are practical trade-based improvements like I've just outlined. We should always be looking to have better trading relationships with every jurisdiction around the world. I think that is a genuinely better way forward. And it's not about the politics. It's about how can we give people some confidence that the political instability of the UK would turn a corner if a Labour government is elected. And I think, to be honest, it is quite noteworthy that for the first time I'm aware of, we can make a case to businesses in the UK and say the political risk in this election is the continuation of a Conservative government, which is, flopping one way or the other, really quite unusual announcements so far in the election campaign. The real safety, the real stability would actually come from a change of government to a Labour administration. That is significant, but we recognise why it is so important after the last few years of political life in the UK.
Jonathan, talk to us a little bit about how you're addressing perhaps the bigger companies, the multinationals that are ultimately looking elsewhere for that growth, who have been super invested in the UK for decades to come and are now looking to Paris, Frankfurt, et cetera, and are ultimately responsible for the hiring in the UK. What are you doing? What can a Labour government do to appeal to the big corporates based here in London?
Yeah, absolutely. It's a conversation I unfortunately have found myself having on several occasions, even in sectors where, to be frank, I would think the UK has a historical and competitive advantage over a competitor like France. I'm talking about obviously pharmaceuticals and life sciences, and even in some areas of fintech. Now, what those businesses will say to us first of all is, look, you have to be a more stable place. That has to be at the heart of your pitch, whether that's your fiscal rules, whether that's your commitment to, frankly, the kind of good processes we didn't see when the UK had that mini budget under Liz Truss. They do want a clear industrial strategy. They want some confidence that the plans the government have are not going to change day to day. So think about, for instance, the changes to phasing out of petrol and diesel engines for new build vehicles in the UK. That change. They want some stability and plans around that. And then they want a set of actions, again, whether it's on the apprenticeship levy or whether it's on some real ambition around net zero, where they're really quite spooked by some of the government's language around that. It's stability and ambition, really, at the heart of each one of those plans. That's what they ask us for. It's not unreasonable.
Yeah. So, Johnny, they want stability. Let me ask you about China and your position compared to the US and the EU in response, the level of protectionism that you'd be offering. Because it's a choice on EVs, for example, between protectionism and giving poor Brits the access to those electric vehicles.
It is. It is, I think, one of the, if not the biggest business and trade question facing a country like the UK. Now, I always want to caveat this at the beginning by saying, even in the US, where you've got a very assertive set of trade measures in relation to China, you do obviously see bilateral trade at record levels. So it's a more complex picture than is sometimes described in some parts of the media. Look, I am concerned about unreasonable, unfair competition from China when it comes to things like EVs. I want to see cooperation with China where we can do that, but I've got to take a view which obviously makes sure that international competition in the trading system is a fair one. I am waiting to see how the current government may react to what we've seen in terms of what the EU might do. But I do also recognise that, frankly, what the US or the EU will do will obviously have an impact in terms of where trade diversion may come from on the UK. So, look, I am very worried about some of what I think of as unfair competition, but I want to make that and activate that in a way which tries to make that trading relationship a one that endures where we can do that. But it's got to be fair competition.
All right, Jonathan Reynolds, UK Shadow Secretary of State for Business and Trade. We'll let you get back to the campaign trail. Thanks for making time for us this morning. Now, coming up, the French president renews calls to buy European. More on Emmanuel Macron's visit to Germany coming up. This is Bloomberg.
This is Markets Today. We are about 43 minutes into the European trading day. Kind of net, seeing a little bit of a boring session when you look at the stock 600. It feels like a lot of investors doing, one, the catch-up trade coming back from the long weekend, but also perhaps waiting for some of that macro data later in the week as well. We are getting some lines here coming from the Fed's Kashkari. Remember, he is not a voting member at the moment. Recently speaking in a CNBC interview, not really deviating from his message. Remember, he's kind of known as the hawk of the FOMC committee, or when he was a voting member, saying that, look, the U.S. economy has remained resilient. They're in a good position of the strong labor market, ultimately saying that there's no need to rush and cut rates, saying that ultimately you need to get more confidence in the pricing. This is something that you're starting to hear more and more of the folks over at the FOMC actually talk about. This idea here that maybe we don't need to cut rates, maybe even hiking, getting back onto the the narrative a little bit.
Well, certainly for some, those FOMC minutes were seen as relatively hawkish, given that they weren't ruling out at least some of members were not ruling out a further hike in interest rates. Of course, we have the PCE index out on Friday that will inform the view on the Fed in terms of inflation. Currently across the 2-year in the US, 492 at the front end. So yields just down 1 basis point, close to 2 basis points. The 10-year at 445, currently down just 1 basis point is the move across the Treasury curve to 445 on the 10-year, 492 on the 2-year.
Yeah, look, it kind of brings me back, and I love you. I know that I said I love you on air, Kriti.
I'll take it.
I know you love to quote.
Someone should.
The rumours have been there for a long time, and now we've had it officially confirmed, Lizzy. Yeah. That's lovely.
Well, I do mean that, but what I meant to say was I know you love to quote Anna Wong, the chief US economist here at Bloomberg Economics, and just back on that labour market point that Kashkari's making, Anna Wong kind of asking whether the Fed is so inherently dovish, so keen to cut rates, that it's too quick to conclude, for example, that when immigration increases, it's disinflationary, and kind of put all the other evidence aside. So tying into that labour market story.
Yeah, that's a really interesting point, isn't it, from the team at Bloomberg Economics. There is this bias, the love point as well, Lizzy. There is this bias to cutting, is the view from Bloomberg Economics. They think that the moves around immigration, productivity gains, are going to be positive in terms of the trajectory of inflation, but they're more likely to go for a cut if they see trouble in the US economy. Talking of inflation, and this is something that Mark Cudmore was talking about on our own live team, is the move maybe. The focus has been on services inflation, how that's been relatively sticky, but now maybe goods inflation starting to pick up as well. Part of that down to what we're seeing in terms of industrial goods and prices around the input prices of some of those metals, but also maybe the shipping industry as well. The global goods trade showing signs, by the way, of accelerating after last year's slump. That's pushing up shipping rates and giving some supply chain managers flashbacks to the demand spike that disrupted international commerce 3 years ago. Let's get more then from Bloomberg's trade czar, Brendan Murray. Brendan, what has caused this latest spike then in terms of shipping rates? How worried should we be about this and the inflation impacts?
Right. So if central bankers are looking for a place where inflationary pressures are going to ease, they're not going to find it in the global trading system right now. At the moment, the shipping industry is getting it from both the demand side and the supply side. The supply side being the attacks in the Red Sea, constricting the amount of capacity that ships have to carry cargo. They have to go the long way around Africa now. That cuts the capacity by about 20%. You add to this the upcoming peak season for shipping, when retailers and other companies restock their shelves or make sure they have enough inventory on hand heading into the second half in the year-end holiday season, and you've got a supply-demand situation that's pushing shipping rates up at a rate that we haven't seen since the big crunch during the pandemic.
How long does that last, though? If we're talking about the squeeze, I'm immediately thinking it's back to school season in a couple of months. In the States, that requires a big kind of front loading over the summer as well in terms of shipping goods to those retailers. Give us a timeline here.
Yeah, at the moment, it looks like that it's feeding on itself, that the drive up in shipping rates is just encouraging more demand, so you're not caught out short in a couple of months. But the longer-term picture is that there's a lot of shipping capacity coming online over the next 6 to 12 months. The big carriers bought new ships with the big windfall profits that they made during the pandemic, and those are just going to come back. Those are going to come online, and most analysts would say that that's going to put downward pressure on shipping rates.
So how then do you model the impact on inflation if after every supply squeeze you get these adjustments and the expansion of capacity?
Yeah, exactly. I mean, there was a big debate during the pandemic about what the percentage of a shipping rate as a share of overall inflation. And most economists would say it's pretty minimal. You can put a lot of TVs in a container and the per unit cost is pretty low. So there shouldn't be a huge inflationary impact, but there's not going to be much of a deflationary impact either.
OK, Brendan Murray, really interesting deep dive on the changes in the shipping industry and what it means for potentially a slight pickup in inflation, higher prices, as we look at that squeeze and to what extent that could be abated in the weeks and months ahead. Brendan Murray, our trade czar, thank you very much indeed. Now let's get a crossover to Germany, where French President Emmanuel Macron says the EU must stop being naive in the face of growing competition from, yes, China, but also the US. During a visit to Germany, he's repeated calls for a buy European strategy in key sectors like defence. That sounds like it's lifted straight from the playbook of Joe Biden. Let's bring in Bloomberg's Oliver Crook, who's on the ground for us in Frankfurt. Ollie, Scholz and Macron, to what extent are they on the same page on some of these issues?
Right. Well, listen, it's the first state visit in 24 years, and they really want to make a show of the fact that they're getting along, which we know to be sort of in dispute, right? This has been a sort of tense relationship for the last couple of years. And basically, they've come out with this sort of op-ed in the Financial Times, really outlining what the sort of pre-election pitch for the next parliamentary part in the EU Parliament, really saying that, listen, we need to buy European, we need to be autonomous, we cannot rely on the things that we've relied on in the past, and their ambitions are, as ever, very great, right? They want to still decarbonize. They want to get forward on defense, but also on AI and quantum computing, all of these things. The question is, what is the formula to how you actually do this? They want to slash bureaucracy. That's part of it, but they also need to attract huge volumes of investments, and that is where the Capital Markets Union comes in, and that is what the two of them will be discussing today. And really, for them, the Capital Markets Union and many politicians in Europe is sort of the silver bullet to solve a lot of problems, to attract huge volumes of investments, to unleash American-style capital markets, and has the also added advantage of not having any of the thorny conversations around, joint debt. It's sort of free in that sense. The disadvantage of the Capital Markets Union is that it is intensely boring as a topic. It is also very sort of convoluted, and what you don't pay for in euros, you pay for in political will, which is why there's not really been any meaningful progress in the last 10 years that this has been sort of circulating as an idea.
Ollie, in addition to that conversation, in the meantime, Ukraine's Volodymyr Zelensky is in Western Europe. I believe some headlines across the Bloomberg terminal around security arrangements with Belgium at the moment. What else is he hoping to leave with?
That's right. He's in Belgium now. He's expected to go to Portugal next, and he went to Spain just before that. And really, he left Spain with €1 billion worth of commitments in military hardware, which is fairly significant, right? So they've said that they will give them Patriot missiles as well as ammunition, and also key 19 Leopard tanks. And all of this stuff, or much of it, will be delivered by the end of June, which is pretty quick turnaround. And this is super sort of relevant right now because you have another problem, right? So these bilateral agreements between Ukraine and European nations are increasingly important because Hungary is blocking tranches of payouts for the European €6.5 billion fund that they have set up. They're basically blocking that. So it becomes increasingly important to get those sort of individual disbursements. And that's what Zelensky is hoping to get as he goes across the continent. And remember, over the weekend, we were talking about the G7, how they're trying to get that sort of financing for Ukraine on firm funding, not just for this year, but for the years to come with those frozen Russian assets, in part to sort of Trump-proof these payments to Ukraine. Well, increasingly, it looks like Europe needs to Orban-proof them as well.
Really interesting stuff. Oliver Crook, we thank you for your coverage and of that G7 meeting over the weekend. Lovely to have you on. Now, let's take a look at some of the other events we're following today. As Ollie says, it's day 3 of President Macron's visit to Germany, healing the relationship with Olaf Scholz there. And then later today at 3 p.m. London time, we have US consumer confidence expected to deteriorate in May, reflecting all this pessimism about jobs and incomes and future business conditions. This as the labour market cools and prices stay elevated. At 4:30 p.m. London time, then, we have the 2-year Treasury auction. At 6 p.m, the 5-year Treasury auction. And starting today, as Kriti has been reminding us, it's T+1. Lots of plumbing issues potentially as US equities change the timing of how long they have to settle. Finally, we've got lots of central bank speak, less than last week though, but some from the Bank of England's Catherine Mann and, as we've been discussing, the Fed's Kashkari.
Kriti, talk to us about plumbing.
Let's talk about plumbing. I couldn't help you with the rest. This is a really important story. The T+1, the settlement. I looked at some of our Bloomberg reporting as well. They compare this to the 1920s, the roaring 20s, back when the settlement used to be 5 days. And this was a lot of bucket trades back in the day. If anyone's read Reminiscences of a Stock Trader, I'm getting really nerdy here, Tom.
Are we going back to the 1920s?
That's my point.
And then it was roaring, and then there was so much activity, then they had to extend it out.
But it was because your big institutional investors of the day were starting to get basically washed out by retail investors, these bucket traders that they were called at the time. It's a similar story that's prompted this now in 2021 with the meme stock frenzy that, by the way, is rearing its ugly head a couple of times. With the GameStop we saw it with the Archegos deal as well. This is really interesting to me because this feels like a no-brainer in so many ways. Why not make the markets a little bit more efficient? But look at the way that some of these banks are prepping for it. Jefferies, for example, a $3 billion cushion around it. Citigroup, Citibank and Citigroup, talking about moving staff to Kuala Lumpur on a Tuesday to Saturday schedule just to deal with the fallout. I mean, there is some concerns about the plumbing at the end of the day.
Yeah, the SEC saying that the transition may lead to a short-term uptick in settlement fails and challenges to a small segment of market participants. You have to wonder whether they've had loads of time to prepare for this, really, to relocate the staff. The question being, though, is everyone equally ready to keep up?
Particularly foreign investors, right? Because they have to get the dollars to make these clear these trades in that time, in that shortened time span. So it's maybe, the argument seems to be that it's maybe foreign investors who are potentially most at risk in terms of any impact. But yes, the SEC has been relatively relaxed about this. At least their messaging has. But many market participants are saying this could cause tensions within the system. So we watch to see how that unfolds then.
Well, the timing is really interesting here because if you look at the positioning in the FX market right now, everyone is still long dollar. There is still an abundance of dollars at the moment. So that concern that the FX market works at a T+2 delay perhaps may not be as relevant. People kind of know this. They've been preparing for it. But it's curious to see how much the T+1 thing will affect the FX story. I should also mention this is right now a U.S. settlement story. When you come to the U.K., they're still not on T+1. So international investors who want to get into the U.K. market, they're looking to say no later than the end of 2027, which feels like a lifetime.
We take our time over here. It's fine. Check back on these markets. It's a bit of a nonplussed market day. There'd been a bit more optimism leading into the open this Tuesday, but currently across the benchmark, you're flat. You're down 0.2% on the FTSE 100. We'd started in the green. You're down on the CAC 40 over in France by 19 points, down 0.2%. You're only getting gains so far in the DAX over in Germany, the FTSE MIB just eking out 0.1%, and over in Spain, the IBEX in similar territory, just adding 13 points. US futures pointing out just by 0.1%.
And I should say, you just mentioned the IBEX. We're just getting a headline crossing the Bloomberg terminal. Spain is denying its plan to scrap the energy windfall tax. That was something that Joe Easton mentioned earlier was actually driving Repsol up higher as well. You're seeing a little bit of those gains on the IBEX now paired off those headlines. We're, of course, going to keep you fully apprised of those comments. And the FX story to me is fascinating, though, especially as we talk about elections and factoring in the UK election, factoring in the EU story. We have some great guests on this morning. It's data in the back half of the week. It's elections until then. Of course, all eyes on South Africa going into tomorrow. We didn't even mention the Anglo BHP deal. We're still waiting for headlines on that. We'll bring it to you live on Bloomberg TV. That does it for Markets Today. The Pulse is up next. This is Bloomberg.